The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you. You're listening to the Telltales Weekend Update. I'm Ava Cabot.
And I'm Marcus Graham. Every Saturday, we walk through what happened this week and what's coming next week across the 89 companies in the cash flow memo. No filler.
Quick note before we start. This is a pilot episode, so we want your feedback. What works, what doesn't, what you want more of. The show is produced entirely with AI tools, and both voices you're hearing are AI generated. We welcome your feedback. On Wednesday, Mike, Jason, and Hunt spent most of episode 2616 on Hormuz, the deficit math, and the dominant company debate. Lilly, NVIDIA, Microsoft. Today, we pick up downstream of that conversation with the first big week of earnings season behind us. The AI build kept accelerating. A streaming founder stepped off his own board, and one of the cheapest stocks in the healthcare book heads into a print that could re-rate the whole managed care complex. Let's start with chips. 3 names on page 3 of the memo set the tone this week. Taiwan Semi and ASML reported, and Intel reports Thursday. Same cycle, 3 very different places on the cash flow map. Taiwan Semi first. The company reported Thursday morning. Revenue $35.9 billion, up 41% year over year. Net profit up 58%. Both records. High performance compute, which is AI plus networking, was 61% of revenue. 3 nanometer was 25% of wafer revenue. The Q2 guide came in at 39 to 40.2 billion, 10% sequential growth, unusual in that seat this time of year. And CapEx got pushed to the high end of the 52 to 56 billion range. AI demand is not slowing, and the purest shovel in the build is telling you the order book is still accelerating. That matters most for NVIDIA, which reports May 20th. On the same page, ASML, revenue 8.8 billion euro, order book called very strong, and management raised the full-year guide to 36 to 40 billion euro. Stock traded down 3% on the open anyway. Marcus, what does the memo say about where ASML trades?
ASML is expensive. The stock sits at 74 times free cash flow and a free cash flow yield of just over 1%. Trailing 12 months, the company generated $7.5 billion of free cash flow, up 17%. That's clean growth, but it's growing into a price that already prices in 3 more years of raised guides. The stock sold off on a raised guide because that multiple leaves no room for a stumble. If the memo number is your anchor, ASML is the chip stock you own for the monopoly, not for the cash yield.
Then Intel, same page. Stock is up 76% year to date. The rally is built on 2 narratives: the $25 billion Terafab joint venture with Elon Musk and Intel's plant, and a foundry deal with AWS. Thursday's print has to validate both. Marcus, how does this one read on the memo?
Free cash flow for the trailing 12 months is negative $16.2 billion. This is not a cash flow stock. It is a restructuring narrative riding on whether the Terafab commitment converts into revenue inside of 2 quarters. The debt sits at $46 billion. If Thursday's guide doesn't move that story forward, the 76% rally is doing the work of a beat that hasn't happened yet. That said, I'd expect Intel to talk up booming CPU demand on the call. TSMC's leading-edge capacity is sold out, and hyperscalers need a second source. At the leading nodes, Intel and Samsung are the only options.
3 stocks, same cycle. One with no cash flow, one expensive on cash flow. And Taiwan Semi sits in between, still cheap on the multiple, still growing into it. The memo is how you tell them apart. To the deep dive. Netflix, page 4. Reported Thursday after the close. EPS beat handily. Revenue up 16%. The ad business reiterated a $3 billion revenue target for 2026, with over 4,000 advertisers on the platform. The stock dropped the most in 6 months anyway. 2 reasons. The Q2 revenue guide came in below consensus. And the bigger one, Reed Hastings is not seeking re-election to the Netflix board, 28 years after he founded the company. Marcus, the memo has Netflix at a price most listeners wouldn't call cheap. How does the print change that?
It doesn't change it. Netflix trades at 39 times free cash flow. That's priced for a growth and moat story. But trailing 12 months, free cash flow came in at $10.5 billion, down 14% year over year. Growth going negative at 39 times is how multiples compress.
Management has been giving cash back hard. Gross buybacks ran almost $7 billion in the last 4 quarters, roughly $4.8 billion net of stock issuance. Does that cadence hold from here?
$4.8 billion of net buybacks on $10.5 billion of free cash flow, about 45% going back to shareholders. It's a real capital return program, and it's been the stabilizer for the share count and the multiple. The question is whether you keep running that cadence into a year where free cash flow is shrinking. There's a content arms race pulling capital in, and the founder is stepping off the board. The easy answer is no. You'd expect a more conservative allocator, which Greg Peters and Ted Sarandos are, to slow buybacks, redirect to content, and let the multiple do what it's going to do.
Hastings built the model where cash return was the discipline that kept Netflix from rerunning the content spend cycle. That discipline is now leaving the room during a content arms race. Also, earlier this month, Netflix lost the bidding war for Warner Brothers content to a competing streamer. Streaming consolidation is real. A beat quarter with a founder exit and a soft guide at 39 times cash flow is not what you want going into that fight. Forward week. Big slate. 4 names to watch. United Health, UNH, page 19, reports Tuesday morning. Consensus wants 6.63 in EPS on 109.4 billion in revenue. The setup. On April 7th, CMS raised the 2027 Medicare Advantage rate by 2.48%, the first favorable rate rule in 3 years. The memo has UNH at 3.7 times free cash flow, with a 26% free cash flow yield. That's not a normal number. The market is pricing in a permanent impairment, and the print is the first chance to push back on that. If UNH beats, managed care re-rates. Tesla, page 1, reports Wednesday. Q1 deliveries already missed. 350,000 against the company's own 365. JP Morgan flagged 164,000 unsold units in inventory and laid out a 60% downside scenario. The memo shows Tesla with negative free cash flow of $5.1 billion over the trailing 12 months. The earnings number is not what this print is about. It's the physical AI language on the call, whether Musk gives a robotaxi date, an Optimus milestone, or a new revenue line that the market can attach to. That's the whole bar. McDonald's, page 16. Not reporting this week. The Q1 print is May 7th. But Tuesday is the launch of the new McValue menu. Under $3 items, $4 breakfast, $5 lunch. McDonald's is a cash flow bellwether for the low-income consumer. Memo has McDonald's at 38 times free cash flow, with debt to free cash flow at 7.7, rich on cash flow and highly levered. Watch the first 2 weeks of menu launch traffic data as a read on whether the low-end consumer is responding. Real signal comes on the May print, Uber, page 20. Not an earnings name this week, but the big catalyst. Uber committed $10 billion this week to build a robo-taxi platform by 2028. 28 cities, Lucid and Nuro as hardware partners, employee test rides launching now. This is a break from the asset-light model that Uber's valuation rests on. The memo has Uber at 11.7 times free cash flow, cheap by tech standards. That multiple was earned by being capital light. $10 billion of robo-taxi capex puts part of it on the table. Watch the reaction on the May 6 print when management quantifies the spend. Hunt, Jason, and Mike will pick up Intel and Tesla on Wednesday's main Telltales episode. If you want to follow along, the cash flow memo is at telltales.ws. Long pause. The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security, nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the host nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, express or implied, is made as to, and no reliance should be placed on the fairness, accuracy, timeliness, or completeness of this information. The host and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned.